All right, so we're here with Mr. Akiba Leisman again, and he has been able to acquire another project here, which we sort of spoke about last time, which wasn't too long ago, 4 or 5 months, and the characterization which we were sort of hinting toward in that conversation just sort of played out, to a fairly great extent. So we like to see that guys, doing what they're what they say they will be doing, and it's actually happening. So it's great. But I think before we get into what everyone wants to hear about, which is Moss, let's just go through the existing assets first, just give an update. So if we start with Q3, Q4, you hinted that Q3 would be weak when we spoke last. It was weak, and Q4 was very fantastic. So that's the jigsaw of San Albino, I guess. But maybe you can just brief us on Q3, Q4, and then speak to 2025 outlook for San Albino.
Sure. Actually, looking at Q3 and Q4, you actually also have to look at Q2 in that context. And it all comes down to we had a minor delay in the grand scheme of things. It was kind of a nothing burger when it comes to getting a full environmental impact assessment approved. Wound up being about 5 months later than what we were anticipating at the end of 2023. So that a few things actually impacted that. Last time that we had a conversation, we were just coming off printing our Q2 numbers, which were actually really, really good. We wound up selling over 12,000 ounces of gold, recovering about the same. But if you actually walk through the details of Q2, we were actually restricted in where we were able to mine because we couldn't access certain parts of our ground until we got that EIA approved, which happened in July. So we were almost forced to high grade the mine in Q2. So our numbers were elevated because of that. And then in Q3, at the very early part of Q3, we got the full EIA approval over at Las Conchitas, but we were behind maybe about 2.5 months in our pre-strip. So most of the quarter was really there, moving all of the waste material and some of the other zones, because we do need to be mining in 5 separate areas simultaneously in order to feed the mill at the level that we want and get the production levels that we want. So if we only had access to 2, we needed to basically move a lot of waste for the other 3. So we entered into the high grade part of all of the zones towards the end of September, so about 2 or 3 weeks before Q3 ended. And then when we printed those numbers, we only recovered like a mid 5,000 ounce gold number. We sold a little over 6,000 ounces of gold for the quarter, which was expected. I mean, this was part of just like catching up from that permit situation. I let everybody know that Q4 was just going to be back to normal. In fact, it already was at the end of Q3. So if you actually look at our numbers over at Q3, they weren't actually all that terrible. We actually generated net income for the quarter, but it was certainly constrained for most of the quarter. And then in Q4, we wound up recovering over 12,000 ounces of gold. We sold nearly 11,000. And really the difference between those two numbers is anytime that you go from a low grade steady state to a high grade steady state, invariably you're going to be building up inventory. So there was a little bit of a catch-up provision over in Q4. But what we put in that press release associated with our Q1 operating reports and a little hint with the Moss acquisition is that our cash balance just for the quarter in Q4 went up by US $9.5 million for the quarter. So to put this in context, this is not just a cash box mine that we have over in Nicaragua. We have a big boy exploration program going on in Nicaragua. We have a pretty substantial geotech and hydrological drilling program going over in Guyana, and we'll put some let's call it accidental results that came from that drilling program because it wasn't intended to be an exploration program. We'll put that out over the course of the next week or so from Guyana. But all of them actually, if you add up what we actually have to spend on growth capital for both of them, it winds up being quite a few $1 million per quarter in terms of our actual run rate. And then on top of that, there was further debt repayment. We're almost completely done with the Sailfish silver stream, and even on top of that, we were able to generate US $9.5 million, which lo and behold was a substantially larger number than the actual acquisition price that we announced for this new Moss acquisition. And I'll correct you, this was not a project that we acquired. We actually acquired a mine that's still producing gold as we speak.
Yeah, and we'll get into all of the details soon enough. But I just want to speak about the underground mining, which is probably the main pathway of eventually, having enough mining phases to be able to increase throughput down the line at the series of mining camps you have in Nicaragua. So where are we at with that right now? Because we were speaking with Q1, you were going to sort of move into the first creating the first portal and starting to test this out. Where are we at in
Yes.
terms of timing?
Right. So we did actually quite a bit of geotechnical work in, let's call it Q3, Q4, and then even a little bit at the beginning of the year right now. Jesse's down at site, coming back from Nicaragua in the next couple of days, basically kicking off what is going to be the finalization of the engineering plans for the portal. And then we've already kind of informs the government about what our intent to do for the underground development. So they have basically a framework for what will be a permit amendment in place. Our read of this and kind of the government's acknowledgement of this is that this should be a fairly benign process of moving to that permit amendment. Assuming that's the case, and we've had a couple of minor permit delays in the past for also fairly benign permit amendments as well. But assuming that's the case, we can start actually spending the capex to drive those port tolls down, because there will be more than one, probably by the late part of Q2 of this year, and then we'll have first production at the very end of this year coming from the underground to supplement the open pit as well.
And if you speak to some numbers, what do you think the initial capex would look like this year on that? And the permit amendment thing, how long would that take? Just give a bit more color on it.
Yeah, and also just in context, all of this gets funded through the cash flows generated from Nicaragua. You don't even have to worry about,
of course,
the Arizona asset coming from this. But soup to nuts, what we're doing here is we're not sinking a 1,000-meter shaft and then doing all the development work that comes from it. There's definitely specific challenges that come from an ore body like us, horizontal dip and kind of like this narrow vein system. But one of the benefits that come is that you don't actually need to do all that much lateral development to move something in Nicaragua. So the one thing that we have to deal with in country that we think we're going to need to do is that the main ramp and the main portal are going to need to be done on a 4x4 meter basis. So there's actually quite a bit of dirt that needs to be moved from an underground construction perspective. The actual lateral development is not all that much. When you're talking about something that's going to be maybe 50 to 65 meters lateral, you're talking about a few thousand meters of overall lateral development in order to access the ore body. So when you add up everything, you're talking about a number that's going to probably be in the context of about $5 to $7 million all in from a US dollar perspective before you get into a underground mining source cash flow, if you will. But again, all of this is going to be supplemented by the production that's coming from the open pit right now. So it's not an external capital need, but it definitely is going to be a redirection of capital to get there.
Yeah, and the with that sort of initial capital spent to do that initial development, what sort of tonnage do you think you could mine on a daily basis once that's up and running in, say, Q1 next year, whatever? You'll start in Q4, get started, but in, say, Q1 next year or something like this.
Yeah, we're still trying to figure out what reasonable throughputs are going to look like. Because one of the things that we're trying to do is that even though the actual ramp is going to be like 4x4, we're not actually doing that on the actual like ore body development over here. So we're still kind of working out is that what exactly are going to be the smallest pieces of equipment that we can get down there. Because we would much rather mine this at a lower throughput, higher grade. From the dilution perspective when all is said and done. So, I mean, to put this into context, if we didn't actually care about dilution, if this actually was a 4 meter wide ore body, we could easily get out 700-800 tons a day just from the underground over here. We don't want to do that. Like that
Yes.
that would be negative for a whole host of reasons. The dilution of the grade. Yes. We have obviously the preg robbing issues with our ore body on the hanging wall and footwall that we need to limit dilution is that. But if we can get this to the tightest control that we think is possible, you're probably looking at supplementary production that can be anywhere from 200 to 250 tons a day. I shouldn't say supplementary. It would be basically as part of the mine plan to continue feeding the mill at the current throughput of about 600 tons a day.
Yeah. So some of it might be out competing other open pit material.
Yeah,
but
no, like one of the
mostly
big
just
things.
reserve and resource.
Yeah, no, like we're like just going through our exploration budget for this year, and that's exactly right. Because like part of the issue with us is that there's a lot of like targets over here, but
Yeah.
everywhere on the property, it's a fairly complicated uh, ore body. So it's not like we can go and basically say, you know what, go to that area, develop it, just sink a lot of capital from the exploration side, and then do everything that needs to get done in order to get this into production. That's the acquisition of the service rights. For those that have been following the Mako story for a long time, the entire reason why we had that EIA delay of 4 months, and again, that's not a big delay in the context of mining, was because we had our bulk sample delayed. It was the first bulk sample that was ever given to a Nicaraguense company from the government the previous year in 2023. And the only reason why we went for a bulk sample was because we wanted to defer some capital spending on the surface rights back in 2022. So you can see how this decision process kind of went along. But if we're going to be going to different areas of the property on our 180 square kilometer of ground that we have over here, we're going to need to go through the same process. So anytime that we can expand the amount of time that it's going to take in order to do that on the open pit for exploration, it's good. So when we're going through an exploration budget where we actually have to look at competition for not only capital but also from a practical scheduling perspective, everything gets optimized as like the highest priority is the underground, where it's not just about geological prospectivity. It's literally about how we can actually go schedule this over the course of the next 2 and 3 years in the mine plan, where it becomes a little bit more of a challenge to bring in external sources of material, because at the end of the day, this is not an exploration company. Anything that we're going to be spending money on the exploration side of things is going to have to come into the mine plan in a reasonable time frame. So yeah, no, the underground becomes important in that regard.
Yeah, and we'll just let Jesse leave his comments now about this, and maybe we'll have Frank comment a bit as well on the exploration here. But generally speaking, when will you communicate to the market more rigorously what the budget will look like? Is that going to be a Q2 thing? What do you expect there?
Yeah, I think when we still have to kind of finalize some of the engineering design parameters for both of the portals that we're going to be drilling. So once that actually happens, then we're going to submit a permit amendment, and we think we have an agreement in terms of the framework of what that's going to look like. So we don't actually think it's going to take all that much time to get done. And then as soon as we have the permit, we're ready to go. We'll communicate exactly how much capital we anticipate spending until we get to first production. We don't expect that time frame to be, once that permit is in place and once everything is over at site, you're looking at about a 5 or 6 month development schedule before you actually have first ore coming to the crusher.
I guess just to start with San Albino, the underground mining is getting more advanced now. Can you speak to how you would like the year to go in that regard, and what it would mean for San Albino, and what sort of challenges you foresee with the underground mining?
Yes, the underground mining is crucial for us to go underground. As the mine was permitted, we are permitted to go 1,000 tons a day. We've been pushing around 650, 700 at the most, but we got about 80% of the plant designed to go to 1,000 tons right now. But we've been having challenges on keeping that amount of tonnage as an open pit. Underground will definitely would be something that it's always been on the plan. Always, our plan was always to go open pit for the first couple of years, well, 3 years, and then go underground. Define the geology there as much as we could. I think Frank mentioned a little bit about challenges that we have on those veins, ore veins that we have in there. So going underground historically has been a very a productive project, and that's what we intend to do: go underground. And hopefully, at the end of this year, we'll get our portals going and get start supplementing the open pit mining with underground.
So you would foresee, I mean, theoretically, with this current setup you're contemplating now, two portals or something like this, what sort of
Yes.
throughput do you think you could pull out once you, I mean, maybe not end of this year, but getting into Q1, Q2 next year, if you wanted, how much could you mine, you think, effectively, without diluting?
Our target is about 200 to 250 to start with, and as we open, the key to this is like an open pit. We have to have two or three fronts, mining fronts at all times, so we can be able to mix and blend materials. All that thing, the deposit is challenging in the fact that it does some preg robbing materials that you have to be careful, find them, identifying where they're at, so you can blend and mix. And what we've done is an open pit for the last 3 years, and be able to maintain the recovery as high as we can on the at that plant.
So it sounds to me likely, I mean, that will initially be a great stabilizer, but it will not be enough to merit the 1,000 ton per day expansion. You would need to open maybe another underground mine before, or another open pit or something, before you make that step.
Exactly. What we have done in the last 3 years, we've um, ran through several pits now that we left up to 20 grams from the wall, right? So we know the ounces are there, and we know we got to get to it. And I'm telling you, it's very hard to walk away from a pit wall that has 22 grams on the wall. And so we just dying to go underground. Yeah, exactly.
So you do this once, and then duplication will be that much easier. You get to set up for one underground mine, then you can do it more easily for the next one, and so on. So
Exactly. And
yeah,
and it's all based on the economics, right? If we feel that going underground makes more sense, weighing the options or the economic options, we're going to do. With the price of gold where it is right now, it's a lot of options to go after go via underground or open pit. So
yeah,
um, we are very focused on run the economics on both and find out where we're at. Obviously, underground doesn't have as a high cost as a reclamation as an underground, but it is going to be a cut and fill underground. So it'll be challenging. And obviously, we're sitting on top of the old San Albino mine that happened, 80, 90 years ago. So we know it works there. We know the ground is challenging, but I think it can be done. Some of the old workings are still holding up pretty good as we speak. So they're there. So
yeah. So just to summarize for people, this year, what are the milestones that we should look out for in your mind? I mean, the key objectives, and when you think they will happen this year with the underground mine.
I think I say we got about 80%, 85% done on the engineering done. We're pretty much permitted already to go, with the exception of some additional work that we got to do to obtain our permit. But like I said, we have an active permit for 1,000 tons a day. That's not a big challenge. The challenging is us ramping up and getting an underground contractor going. Obviously, defining the port, and I think we got most of the engineering done for underground design. We're working on that. We're just working through that as fast as we can. I really do think that we'll probably be by July. We're going to be already scratching the surface and figuring out where our portal is going to start. Hopefully, on the third quarter of this year, we can start seeing a portal going on there.
Okay. And then towards the end of the year, in earnest, you will start mining. Obviously, you won't be at 200 tons per day right away, but you'll hopefully be at maybe 50 to 100 tons per day, and then have line of sight to get to the full plant capacity in Q1 next year or something like this.
That's correct. That's correct. Yeah, about 50 to 100 tons, and that's going to be the as we bring in underground. Like I said, we have the open pit that's going to supply us with enough material to keep that plant going. So we're going to bring it in as low or as fast as is needed,
Yeah.
as long as we're doing things the safe way and the most economical way we can.
Okay, so we're here with Mr. Frank Powell, and I think we'll just start off with a bit of an update on San Albino, since lots of drilling has been done, and some very good results as well coming out.
Very good. Well, I thought just show where we're at for this year. We've got three objectives. One is to add additional resources within the currently permitted area at the mine. And what we're excited about is we'll be drilling a number of regional targets aimed at making a new discovery that we can bring into production quickly at San Albino to extend our mine life. And the third item this year is to initiate underground mining. So we've currently got 5 rigs drilling on site. And one of the rigs is doing confirmation and drilling at underground. This is a map showing our the first area that we're going to that we have planned for the underground mining. So we're also doing geotechnical work. We've got the mine design. This is based on the intersects of the drill holes, just contouring the intersects. But you can see we have some fairly large areas of over 20 grams in our contour. So we're drilling that off in detail, doing the confirmation drilling, the geotech drilling, and we're doing the mine design. We aim to get that permitted later this year. Once we have it permitted, then we'll actually start breaking ground and putting in the portals. On the regional side, this shows over 10 targets, and these aren't individual targets. They're actually areas that are pretty large with excellent potential. In fact, we just got permission from the landowner to start here in the south. This area is called El Golfo. And with the historic data, there was 2 significant mines. There was San Albino and El Golfo. And even at that time in the late 1800s, they said, these 2 should be combined into one operation. It's taken us a while to get access to that property. We just gained access, so we're just starting to map, and we should be drilling on that property in the next month or so. And then we've got another number of other targets up here in the north that we've got another rig that we'll send out to start drilling there. So I don't know if you have any questions on
So
San Albino.
I guess with El Golfo itself, could you speak a bit more about the information that exists there? It was a past producing mine. Was it similar in characteristic to San Albino, or is there any notable differences in your opinion?
Yeah, very similar in the characteristics. It was mined underground at that time, and we unfortunately weren't able to get maps of the drifts like we had at San Albino. But at that time, they were saying, well, this is almost exactly the same as San Albino. Since then, the local landowner has been mining, with the open pit, fairly high grade. So we're actually just getting now onto the property to start assessing it and start taking samples. But yeah, very similar grades to what we have at San Albino. Similar style. Vein averages about 1 meter wide. Not unusual to get over an ounce per ton at surface.
Right. So I guess initial scope. Will you bring a few drill rigs over there since you just gained access, or what's the sequencing?
Yeah, the plan is actually the guys are on the ground right now doing mapping and sampling and outlining where we'll place the rigs. So by the end of the month or early next month, we'll send out an initial rig, and then we've got access to additional rigs. So we want to accelerate it as quickly as we can, and just kind of depending on the results and the logistics on how many rigs we'll have operating there.
And as we know, RC drilling was a game changer for you guys. It stepped up where you were able to actually outpace depletion and incrementally add to inventory over time. And now a new component is coming in, which is underground drilling, right, and also underground mining. Can you speak to that, where you're at with that currently, and from a geological point of view, the significance in your mind of this being a component later this year?
Well, yeah, the underground, on our published reserves or resources, we have almost twice as much underground resources as open pitable resources. Uh, we knew going into it, it was going to be a challenge to mine the open pit and do it, with by limiting the amount of dilution that we have. And we were able to overcome those challenges, and we've been able to successfully mine this in an open pit. We have similar kind of challenges that we need to overcome with the underground. So this initial program is to iron out those challenges. We're confident that we can do it. It was mined in the past underground, but it is a challenging deposit because you get undulations of the vein, the grade control underground. So this initial uh, project is to get underground, iron out the issues, and then down the road, that'll actually really help us to augment our production. But initially, it's to iron out all the issues that we kind of anticipate with the underground mining.
And then some of the new, areas that we were talking about preliminarily last time, El Golfo, San Luis, and these places. And we were already discussing what it would look like realistically. I mean, if everything goes smoothly, you're into something that could be a nice open pit. We were discussing, midway 26, you could have a new mine camp there getting started. So, what's your feeling on that right now? You've seen more drilling done there. A few results has been released. What's your gut feeling on this potentially coming into play? And in not too long from now, actually.
Yeah, I mean, we haven't found any major game changers. Everything is kind of what we have over at San Albino, and then from a time frame and scheduling perspective, I think now that we've gone through, I guess, three effective permitting regimes. The first one was the big one over at San Albino in 2016 and 17. That took an extended period of time just because it was new. And then the other things from a Las Conchitas perspective got permitted in two tranches. I don't actually think either one was different than the other. It was basically the same process. And if you looked at the time that where the permit was communicated to the government to when it was finally given, both of them took around 12 months to get done. I think one was 12, one was 13. So based on that experience, I don't think there's going to be any difference going forward. So let's say you're dealing with a year, then you actually have to look at what exactly is needed beforehand, right? So we're drilling now. There needs to be a critical mass of material that you can develop a pit around, not only for an economic perspective, but also to find out what specific infrastructure you need by the pit, most notably waste dumps and things of the sort. Because at the end of the day, this is a high strip mine. Our mining costs are really predicated on how proximal we can put the waste to the pits that we're mining. And then given that, how much surface rights do we need to negotiate and purchase? Because right now, the only surface rights that the company owns is everything at San Albino and everything over at Las Conchitas. So we'll need to do that as well. And then given that time frame, you're probably looking for new targets. Like if you wanted to say that looks prospective based on a geochem anomaly over here, based on what we can see for artisanal workings in the area, we have a pretty high level of confidence over here to start allocating drill capital to here. In an idealized sense, from the first time that you make that kind of decision to where you actually put it in a mine plan, it's certainly lightning quick in the context of global mining, but it's still going to be close to 3 years to do that.
Yeah.
So we're now in the process of exploring and delineating, trying to get critical mass over here. And one of the key valuable assets that we can bring to the table over at San Albino and Las Conchitas is that if we can wind up getting a pretty significant amount of underground to supplement us, it gives us probably the most valuable commodity that we have in Nicaragua, which is time. So we've always had like a lot of critics on Mako in terms of how we went about this. And the one thing where I suppose that they're correct about it. It wasn't really like our choice. This is kind of like from a geological perspective in terms of how you actually need to mine something like this, is that you're never going to have like a large scale mine life on San Albino. So a lot of what we have in Nicaragua is this hamster wheel approach of trying to get more and more feed into the mill. We've been very successful at doing that. So there's obviously going to be a little bit of additional operating risk that will come to the table when we go into the underground. But I think now that we've actually been doing this for 5 years, we've now gotten to the point where I think we're actually very good at being able to manage the operation this way. That being said, I get the appeal of actually running a 10, 15-year mine life where your management expertise is basically doing daily optimization work and having lunch with shareholders as opposed to what we do now, which is really making sure that everybody's hands gets dirty to make sure that we have enough feed to feed those very, very hungry mills.
Yeah, and it's not a widget factory. Was your headline last time, but it's very true, and it's not going to become a widget factory anytime soon. So it's but it's the asset that's making that is going to make the company, and it's doing so right now. It's,
I had like a few like factoids that I asked our CFO to come back with. So I mean, think about what we actually did. So the plant, inclusive of civil works, to allow it to, because this was initially designed at a 500 ton per day facility, was permitted to go to 1,000. So we actually have most of the civil works to do it. So essentially, the mills were more or less built to a 1,000 ton a day capacity. It's very limited capex, and we need to get to that level. So it was about $32 million for fixed infrastructure that caused this mill to get built. On top of that, before we actually got into first production, there was probably about a 2-year infill program, kind of like taking care of a lot of the geological mess that our predecessors left in 2018 and prior, to make sure that we actually had a mineable ore body over here. So that was probably an additional $9 million. So you're talking about $41 million. This was a company that actually has G&A associated with it. This was probably over the course of about 3 years. We spent probably in the neighborhood of about let's call it about $9 million of overall G&A spread out over a little less than 3 years to get started before we got into first cash flow. So the actual nut to crack on everything from a cash, and usually when management teams kind of like highlight capital, they forget a lot about the stuff that I'm talking about. But the actual CapEx that got San Albino up and running was somewhere in the neighborhood of $55 million, inclusive of G&A, inclusive of exploration work, and everything that it took to get done. Since that time, we funded that with a combination of debt and equity. So essentially, all the debt has been repaid. The last time that we raised equity capital was in 2020, nearly 5 years ago, and we wound up doing that raise where we sold 7.1 million shares at $4 a share Canadian. It was pre our reverse split, so multiply those numbers by 10 on a different share structure over there. 4.1 million of those shares went to the controlling shareholder Wexford, obviously very strong hands, and only 3 were sold to the outside investors. On top of that, in addition to the $35 million or so of exploration capital we spent over the last 5 years at this, we actually repurchased almost all of those shares. So we repurchased like 2.9 of those 3 that we sold. So think about this: all of the debt has gone away. Essentially all of the outside equity has gone away. Our cash balance is up by, we're now holding cash in excess of US $15 million right now. So $15 million of net cash has gone out. And then we've been able to fund a pretty aggressive exploration program that allows us to basically run this asset generating like adjusted EBITDA levels, probably pushing at these gold prices close to US $50 million a year. So the criticisms that we
value accretion,
like San Albino is like so small and it's so complicated. Why do you want to do this? At the end of the day, this was kind of like the kernel that allowed us to do everything that we needed to do. It was a challenge to go on the acquisition strategy, because a lot of the critiques that we get from some of our critics on the investor side are the same critiques that we get for other companies, private and public. So doing that first gold source transaction last year, and again, we only closed that in July. So that was only about 7 months ago that we closed that. Put us into a position where we can now start looking at other acquisition opportunities that kind of finally led to this opportunity that came across our desk at the end of last year over at Moss.
Yeah, I mean, we've gone over this, but I mean, we love the positioning that you guys have with the built-in team, small company like this. You have a niche in the market of a certain size of assets. You'll outgrow that in 4 years, but you have that right now. It's sweet. Gold price is high. It's just very good positioning for you guys. I want to ask one thing. I'm not sure if it's a relevant question, but it's a blanket question. You have a new presidency in the US. Trump is coming in. Nicaragua sanctions. Just give your take on it. Is anything going to happen, or what's the status?
Well, the very first Nicaraguan sanction, which didn't really affect us at all, was from Trump. So Trump definitely, with his State Department, can't remember if that was I think it was probably under Pompeo rather than Tillerson, which wound up putting the first sanctions. They were minor on members of the regime, but not really associated with mining. And then Biden, when he came in, I think the State Department was kind of like this was not a high priority, and then it became a high priority. Like after the Russian-Ukraine war started, became a priority for the State Department to sanction Nicaragua, and then a couple of the sanctions actually related to the gold industry. So one of them was proximate to what we were doing. But other than some minor adjustments on how we have governance in the country of Nicaragua and compliance in Canada and the United States, from an operational perspective, it didn't really affect us. So I don't anticipate there being like any additional stuff, but with a couple of caveats to that. And I said this even before Trump, is that there's always a higher risk of going from sanction 2, 3, 4, however you want to count it, relative to the gold mining industry, to sanction 3, 4, 5. That's a higher probability event than going from sanction 0 to sanction 1, right? So anytime that you break the seal, if you will, there's always a higher level of risk, and then it should be quantified in investors' views of the situation because of that. Likewise, the State Department picks certainly do not get along. Like, so I don't think there's like a great improvement in the relationship between the U.S. and Nicaragua. But I do think that certainly in the first 2 weeks or 3 weeks of the administration, it's clear that sanctions and economic sanctions and tariffs are part of a broader strategy to influence people's decisions on policies that this administration particularly cares about. And probably one of the more obvious ones, especially relevant to Nicaragua, is immigration, right? So we're in the northern part of the country. We're a fountainhead for a lot of the migration. So to the extent that the administrations are gonna butt heads, it would be on that. And we had an interesting experience over the weekend with what happened with Colombia, which I think is like a template for how
quickly though
how Latin American politics are gonna unfold. So yes, there's actually quite a bit of risk associated with this, and people need to keep that in mind. The only thing I could say about operating Nicaragua, it's been great. Like I think it's smooth. The people are fantastic. I think it was kind of like an interesting juxtaposition with like the quality of workers that we have in Nicaragua versus what we actually saw in Arizona. I would if I could actually take our Nicaraguan team and place them in the United States, it would make our lives a lot easier. So in terms of access to really, really good labor at all levels, and that's from people that are doing field work, exploration, all the way to senior management right now. We're effectively running this thing on almost 100% Nicaraguense workforce. It took a while to get everything smooth, but right now things can actually run on rails with that kind of workforce there. So there's a lot of positives. The government, at the end of the day, for all of the the geopolitical issues and baggage that comes with operating here have actually been very helpful to for us, particularly the industry as a whole. I think it's been very transparent in terms of like what our needs are, what our we're effectively stewards of the stakeholders, both us, our shareholders, the community, and everything that goes with it. So we're part of the ecosystem. It's interesting to say the least to navigate some of those issues. So to recap, it hasn't really affected us. I don't think the U.S. administration particularly cares about the gold mining industry in Nicaragua as much as the previous one did, but they definitely do have some touch points and bugaboos that do intersect the Nicaraguan relationship, bilateral relationship with the United States. So there definitely can be a heightened level of risk associated with that. And then we manage the best that we can. Like anybody that's making a gold mining investment is taking a geopolitical risk associated with it, inclusive of what I always found kind of weird is that you have this like subset of investors that say, oh, I don't want geopolitical risk in my gold portfolios. That's why I only invest in projects in the U.S. and Canada. And I'm like, are you crazy? Like it's like just some of the highest level of geopolitical risk is like, because geopolitical risk is not just about where you want to go on vacation. It's not just about how you deal with some of the topical geopolitical events of the day. It's at the end of the day, if you're a gold mining investor, it's about how do you build a gold mine. And it was tough. It was tough to do in the United States up until a few weeks ago.
Yeah, and let's not get into Moss quite just yet. But if you just while we're on this jurisdictional topic, you have a new president in the U.S. You have Moss you don't have any permitting risk there. I mean, it's operating, so you'll just have to improve things. But you're building a vertical in the U.S., a new vertical in the U.S., and the timing seems to be excellent. So can you just comment on that? What your takeaways are?
Well, Moss actually had quite a bit of permitting risk associated with it. It was an operating mine. And then the way this got built, and I like part of the objective as new management coming in after a bankruptcy. So effectively as a financial and operating, for lack of a better word, failure, right, on the Moss side. Part of the objective of like the new management team is to say, oh, we're the good guys here. We're going to fix all the problems that those other people left. But if you actually strip it down, there were actually a lot of like what I would consider to be perfectly rational decisions that Elevation and their predecessors took to get them to the point. It kind of like was a series of these decisions that eventually wound up felling the company. But if you actually look at it from the start, so they hired like a new management team. I think they acquired the asset back in 2011. And they hired kind of this gunslinging mine builder in 2013. So this was in the Obama administration at the time, and they were looking at the landscape, and they made what I think is an entirely rational decision. Is they wanted to start with a pilot plant exclusively on private land. So that's what they did. That was the first time that we actually visited the property. Was a little over 10 years ago when they were building that pilot plant. So that was the initial thing that they did. And then when they wanted to go into what would be considered more of a commercial production standpoint, they wound up trying to avoid the federal permitting process. It was a piece of legislation that was issued in 1969 called the NEPA process, which basically allows the executive branch and all the agencies to basically develop an approach to go get larger scale mining projects built in the United States. And it's turned into kind of like this monster of a process. So they made another rational decision in the context of 2016 and 2018 to avoid that. So in the United States, if you're below a certain threshold, you don't need to get an environmental impact statement through the federal NEPA process. And if you're a relatively small type project, you can go through what's called an environmental assessment, an EA instead of an EIS. And that's what they did. So they wound up getting permitted through this, where effectively we have so somebody asked me what the conversion factor of acres to square kilometers are. We have 165 square kilometers at 20,000 acres of ground. But to don't you can fact check me on that conversion. But the only EA that they had was an entitlement around 497 acres. So they thought anything like above 500 would trigger an EIS under the NEPA process. So they wound up getting it designed on a small basis to avoid going through the federal government. And then if you looked at what they did after they got that EA granted, I think officially it was granted in 2021. Actually, it was one issue before, but they've now had a series of 2 amendments on that. So they're given this 497 acres, and if they ever wanted to expand because they ran out of space, they would have to go to the federal government and say, "Look, I want to move over there for 5 acres." And the federal government said, "Fine, but you need to go condemn 5 acres elsewhere." So they're playing this like game of like balancing act and just like this juggling, if you will, and it caused like a fair bit of bad operating decisions by doing it that way. So, for instance, they placed the crushing plant on top of what we think is about 120,000 ounces of gold. So they both didn't do appropriate condemnation work with some of the infrastructure that they built. But at the same time, it all came from a relatively rational decision that they made, was to try to avoid going through the monster of the NEPA process. So 2 things associated with this. We're still going to operate under that juggling. So we're probably going to have to do at least one other amendment through this kind of juggling process. But one of the executive orders that Trump gave in his, I think it was like day 1 or day 2 of his administration, was he basically blew up the entire NEPA process. And he's been given all of the relevant agencies. And by the way, relevant agencies where they still haven't even selected or confirmed the head. So I think Doug Burgum from the Interior, I don't know if the vote was yesterday or is scheduled later this week. You have Lee Zeldin from the EPA. He's also not confirmed yet. So they actually have to confirm these people. But Trump basically gave them until the middle of February to say, you're going to design a new NEPA process, and it better be designed such that the outcome is going to be give these projects, both on the energy and the mining side, permits in a much more expedited fashion than is what's been going on, not just through Biden, but also through Trump last time. Like it wasn't good even then. Certainly Obama, and then really going back all the way since Richard Nixon when the legislation was first proposed. So the truth of the matter is I don't know what the actual proposal is going to be, right? But everything that's being communicated is that whatever the proposal is going to be, it's going to be one that's going to be designed to really reform how these EISs are granted in the country. And if that's the case, it opens up moss to everything, because everything going back since 2013 has been trying to focus like, how do you get into production really, really quickly? And frankly, it's some of the things that some of the thought processes that Mako internalizes as well. So it's not like, well, you can criticize the execution, like the thought process actually wasn't all that irrational in terms of how they were going through this. But because it took so long to go and get even things as small as an exploration permit, the rest of the ground was basically just left untested. I mean, there was like this one drill program in 2016 where we're pretty sure that they made another discovery, but it was never followed up on because they couldn't get permits to explore while they were going through all these financial difficulties with their balance sheet, royalty providers, operational difficulties as well. And then all of that now goes away, and then we have this wonderful tailwind with a new administration that actually really wants to get these projects permitted.
Very good summary. So before we get back to Moss, let's just speak Eagle quickly here. So you just refresh again. You're going to say the same thing, I bet, because you're holding to your timelines and you're executing correctly. So 2025 outlook, the budget, the key milestones in 2025, EIA submission. When do you expect it?
Yeah, so we're finishing up our geotech work and hydrological work now. So we'll probably be in a position where all of the and kind of like site layout stuff there. So all the basics for what this project's going to look like for permit submissions. That's for the EIA, and then even for let's call it the simultaneous application for the changeover from our prospecting license to a mineral agreement, and then eventually a mining license at the end of the day. Will probably wind up happening in the context of late, maybe mid to late Q3. So we'll be able to submit to the government those two things, kind of like the submission of the EIA application, and probably immediately before that the request to basically approve our, maybe even as much as a quarter before that, the request to change our prospecting license over to a mineral agreement. So that will happen over the course, let's say, of the next 4 to 7 months, and then we anticipate, assuming there's no real concerns about the project that we propose, to be fully permitted for development, say in late Q1 of 2026. That being said, right, so we were aware of the permitting regime in Guyana. But it was still kind of like a surprise to us. So even though we were like fully aware of it, it was a surprise to us to see it in writing what G Mining said about Oko. So they still do not have their EIA approved, but the government has basically given them the go ahead where you can start construction. What's likely going to be a minimum of 2 or 3 months before they actually have their environmental permit approved by all the agencies. I can't think of another jurisdiction. Maybe the United States now is going to be similar, but that is it's a pretty aggressive tact for the government, because they want to see other industries develop in Guyana besides the hydrocarbon industry. So assuming that template still holds, like I don't know if it will. I don't know if because G Mining is a bigger project, more important to the overall GDP of Guyana than we are. But assuming that the same template can be held for us, we could be in a situation where we can start construction by the end of this year. So I won't. People should not hold me to that, because that really is be a requirement for the government to follow that particular template with us. Certainly will not have an EIA fully approved by the end of the year. We can legitimately, following that template, start construction on this project by the very end of this year.
And you feel like your financial backers that you're obviously already engaging with will be comfortable doing that, although the full permits has not been issued officially, since they saw this work for G Mining.
Oh, yeah. Like, so I would say, if anything, I kind of like try to hold back our financial backers, if you will. It's like, all right, let's make sure that we get our ducks in a row first. So from an operational aggressiveness, if you will, our financial backers are always champing at the bit. So we do need to manage that with the overall risk profile that we need to take. I do think that Eagle Mountain is going to be it's certainly going to be a larger capex than we can internally generate from our two operating mines, like San Albino, and then eventually when the acquisition is complete with Moss. So it needs to be external capital. A portion of that could come from our current shareholder base, and then we're going to see if there's opportunities to look for the outside. So I can't speak to what the outside investors outside of our current network would require, but certainly from an internal perspective, if the government gives us a note saying you can start digging a hole, we'll dig a hole.
And those suffering from dementia here from the last update, again, what's the full capex and equity? Do you expect it to be 30-40%, or what do you think?
So the PEA was 96 million upfront. Yep. So PEA is fairly current, right? So that was almost exactly a year ago, in January of 2024. Even with that, there was approximately $15 million of contingencies built into that. One thing that it didn't include is like a lot of the hydro and geotech work that we're doing now. So we're probably spending, inclusive of overhead, close to $5 million in Guyana this year. So net, I think on an overall basis, I think that number is probably right, somewhere in that range. Percent debt and equity, this is not a company where I can have like spreadsheet math with financial providers saying like my business school class said this should be a 30/70 type project. Go
Sure.
give me a syndicated loan for that. That's not how this is going to work. I think because this company does take I think prudent but relatively high levels of operational risk. And a lot of things that we do, it allows us to be nimble and do things like Eagle Mountain and Moss, and even like on how we developed San Albino. Adding to that financial risk is probably not a good idea. So I do think we will err on the side of financial conservativeness, if you will, if those opportunities are available. So I told people
30 to 50 million.
I told people when we acquired Moss is like Moss, we basically bought out of petty cash, and it's not going to require capital to really get back up and running, and we expect it to be in a cash flow positive situation by the end of Q2 of this year. But at the same time, it's not like we have enough capital to build Eagle Mountain, so shareholders should have an expectation that at some point as early as this year that we'll do an equity raise to go and buttress the capex for Eagle Mountain.
Yeah, and I guess I'm just gonna go ahead and say it. You can nod and smile if you think it's fair. So 20 to 50 million is the range US. So it will be a dilution event of 10 to 25%, or at the current share price. And the other aspect here, I guess, is people are. I think people can fairly expect, sort of a 40 to 46, 47 ounce, 1,000 ounce production out of San Albino this year, and then. Moss, I guess, is the big thing that could, if you prove that you can turn around this asset fairly quickly, people are seeing inklings of that into Q3, Q4, then likely the share price will be higher than it is currently. So that will mean the dilution will come down, I guess, and that's maybe a component in the timing of things as well.
Oh, like certainly, but I think people should be like fairly suspect about Moss, right? Because at the end of the day, it was a failure.
It was a shit show.
Like, so it's like generally things fail for a reason. I will say to folks is just forget about anything that we're going to be doing from an optimization standpoint. Just from a financial perspective, between the two big things, which is like the removal of the royalty, the silver stream, and the reduction in G&A, is just on that basis, we're taking $12 million a year off the cost structure of the operation. So people need to just focus on that. And then I'm hopeful that eventually people kind of recognize that we have for these size and types assets, and frankly, open pit heap leach is our specialty. We actually have like a really good operating team, so you should expect there to be operating improvements. And I think that the number that I threw out there, like an incremental 4 on top of that, to get this to about a $16 million a year savings, is not an unreasonable number at all. So
let's go through it stem to stern. You said that the due diligence process, I mean, essentially, you knew about this asset almost more than 10 years ago, and that was through Wexford, I presume. But talk about the recent sort of work leading up to the decision to go ahead here. Talk about the recent due diligence process you guys have had. Then you can just just outline the deal structure again. People can read it, of course, but just outline it, and then characterize the high-level opportunity you see in Moss.
Yeah. Right. So first of all, it was a pretty process-driven bankruptcy. So I guess going back, I think people sometimes need to take responsibility for their own investments and actions. I think anybody on the public side of the equation should have seen that Elevation was an insolvent company going back at least 3 years ago. Right. So I do think that like management teams get a lot of blame in the industry, as well as they should. It's a lot of like bad decisions that are made. It's actually a hard industry. So I think people's expectations are also sometimes out of whack. But sometimes like investors need to take responsibility a little bit as well. Right. So this was definitely one where the status quo, simply from a prima facie financial perspective, was not going to work. And it should have been obvious to most people that looked at that balance sheet going back certainly as early as 2021, but probably even earlier than that. So Elevation wanted to see if there was opportunities to do a broader restructuring. Going back in the context of 22 and 23, we were contacted during that. We already expressed interest in the property, and we told them what I'm telling you right now is that like this is not a sustainable situation. We're happy to go and make a proposal, but you're going to need to give me an understanding about what the financial liabilities are going to look like at the corporate level, at the subsidiary level, and then we can take a look. And it's one of those situations where everybody would have been better off if they just all got together at a table and understood that the situation wasn't sustainable, and then everybody took appropriate levels of haircuts. So the senior lender 70%, the equity holders 98%, whatever the numbers wind up being, they would have been better off at the end of the day. But just people don't act that way, right? So like it's hard for people to make those decisions, especially with the types of stakeholders that were here. Is that this was a royalty that at their run rates and the previous silver prices, they were probably paying like about $6 or $7 million a year. Once we turn this on, that royalty is like about 9.5 at these spot prices right now. And then if you look at royalty math, you can apply like the royalty holder, so it's a public company, trades at 25 times cash flow. So the decision process to actually take an impairment on that royalty is a pretty significant one for a company like that. So it just never happened when they were trying to do this outside of bankruptcy. And then that advisor was not rehired. A new advisor was, and they reached out to us because I've expressed interest in this asset multiple times over the course of the last decade. And they said, should we take a look at it? And I said, yes. Now, for your listeners, you knew that. So think about the timing of this, which is actually kind of important, and a reason why we structured this in kind of like a strange fashion. But there actually was a method to our madness for doing it this way. So Mako actually didn't buy this, right? So yeah, right. So I had Mako's controlling shareholder, Wexford Capital, buy this. And what Mako is going to do, and I'll walk through the specific details, is basically buy it back from Wexford at cost once we actually get approval from the venture exchange to do that, which I'm anticipating happening sometime next month. Now, there's loads of different reasons why we did it that way. One of the big ones is that I sort of knew what the clearing price of this was going to be relative to what I thought our competition was like. Again, this was a process-driven, highly structured bankruptcy process where under court supervision, they wanted to get this out as broad as possible. So this is definitely a competitive auction. And I knew what the closing price would be. As your listeners are aware, Q3 was particularly weak, right? So I ended Q3 with $5 million of cash on the balance sheet, which was not going to be sufficient to complete this deal. So I needed to have like one of two things: either capital infusion to Mako to do this, or I basically had Wexford create a new vehicle to be the acquirer over here. There were other advantages to doing this. So you talk about due diligence. We were actually only given a 1-day period to be on site. So there's actually a lot of like desktop work that we did, but I would not view our like on the ground due diligence to be sufficient to make like a really good mind plan case in terms of what this thing looks like going out on the other end. And I think there's a lot of management teams that are afraid to say that, right? So, and I'll use like San Albino as an example. It's like we've been mining this for 5 years. Every day I learn more about the asset than I do previously, right? So there's a lot of things that you need to know that you just can't know in a competitive process. So one of the other benefits of doing this is that Wexford can be there. We can have all of the necessary diligence at the Mako level for what's likely going to be a period of about a month and a half of just like where effectively our operating team is operating there. If there are going to be like any like major hiccups that we weren't aware of, well, we have that risk adjustment where this was structured as effectively a non-binding letter of intent. It turns out that while the operations were in fact a mess, the actual fixing of that problem was even less than what we anticipated. So it's proving out to be like a really good deal when all is said and done. And then as part of this, and people shouldn't understate this, is that we're a public company over at Mako. If we were going to be putting out a proposal in place, there still would need to be this regulatory window for us to complete this transaction. Our ability to take the keys and start operations 14 minutes after the bankruptcy closed over here was essential. There were things that were going on there that needed to stop immediately and get fixed immediately. We were able to do that, and I don't think we would have been able to do this if Mako was the actual first principal purchaser of this. And then likewise, we also had this whole anonymity issue, is that I didn't really want Mako's name to show up in this competitive process, and then people would get ideas about having a higher bid to try to scuttle the process for us. So all of this is the reason why we actually did this through this kind of like rigmarole transaction. Now, in terms of what the actual deal price and structure is, so we're not buying Elevation. So we bought, or Wexford bought through a subsidiary called EG Acquisition. So EG stood for Elevation Gold. So it was a de novo shell company that was set up explicitly to do the acquisition over here. And then for US $4.65 million, Wexford acquired the subsidiary Golden Vertex, which owned the Moss Mine, subject to a U.S. bankruptcy court provision under Chapter 15 of the Bankruptcy Code to remove essentially all of the liabilities, or most of the liabilities associated with GVC. And then that included the silver stream. So on the property, there were 5 royalties and a stream. The stream being the largest. At full throughput, current silver prices, it's about US $9.5 million a year of cash flow going to what would have been going to Triple Flag. They acquired the company called Mavericks, who did this the original stream back in 2018. And by the way, that stream was structured in a strange way, where not only were they entitled to 100% of the silver production at 20% of the silver price, but if silver recoveries relative to gold were below a certain level, they were entitled to a catch-up provision. So effectively, Elevation was giving them 120% of their silver production per annum, which is why you come up with this $9.5 million a year number at the full run rate. And the other 5 royalties, there was one on a depleted part of ground, which we left. We just don't view that as high value. There was one that was negotiated away with a small cash payment as part of the bankruptcy proceeds, so that's now gone. There was another one that's associated with an option agreement that was acquired through the bankruptcy process, which is not in effect yet. So there's a 30-year option agreement for a piece of ground, and then if we want to exercise that option at some point within those 30 years, we'll owe the owners US $4 million for that, and a 2% royalty. So that was left. And the only 2 other royalties were a royalty that was owed to an affiliate of Sandstorm Gold, so the $1 billion royalty public company, and then a 3% royalty that's owed to the original owner of this asset, Patriot Gold, which is like a nominally public company. So we agreed that's going to go through litigation over the course of the next 2 quarters. If those royalties go away, in aggregate, we'll pay the creditors, not the royalty providers, the creditors, an extra $1.5 million US. If those royalties stay, great. We effectively have a 4% royalty on the current area of the mine. So the $4.65 million acquisition price, there was a small closing adjustment because of some prepaid insurance agreements. So it was adjusted upwards by $95,000. And then the overall legal costs that Wexford took was $155,000. So the aggregate closing price for their cost basis was 4.9. That's the amount that they're selling it back to Mako, plus any of the costs and benefits that come from getting the mine back up and running between the closing date, so December 31st, to when we anticipate this closing in February. Since that time, there was US $1.7 million of cash infused to the company, so that will also add to the price. But on top of that, one of the remaining liabilities that we had over at Golden Vertex was a $15 million reclamation bond to the state and federal government, various agencies. that's collateralized by $3.1 million of cash and letters of credit. We're going to have, at a minimum, 50% of that returned to us on close. So $1.5 million will get returned to us on close. That will offset that $1.7 million capex that we put in. And all this time that Moss is still producing gold. We have like another shipment going out this morning as well. So think about that for effectively, depending on how you count, let's call it $5.1 million. So the 4.9 plus 1.7 minus 1.5. So for $4.9 million, we bought an operating gold mine in the United States that will it's still producing gold. Mining operations ceased in September, and we're anticipating turning mining operations back on in May, and then within a month we'll be cash flow positive.
And just to comment on the structure, I think it's what you should do. I mean, you're utilizing your biggest backer to your benefit. Why? There's no reason for anyone to complain about it. Maybe it's just
it's like there's definitely related party issues over here, right? So, and we have to structure around this and have governance around it. Like, so for instance, we have like a special committee at the Mako board that I obviously have to be there to explain the deal because it's kind of complicated, but they can make up their own right. We have like pretty big hitters on our board that are part of that special committee. But I think people conflate related party with like related party, not related party independent with good, bad, right? So those are two very, very separate things. I think all too often in this industry, we have bad deals that are done because of related party conflicts. So don't get me wrong. I think the intuition is coming from the right place, is that people should be somewhat suspect of related party transactions in an industry as problematic as this. That being said, like we deal with this often, and then people do need to basically look at the actual deal. We'll try to be as transparent as possible in terms of what actually goes on. But I think the criticisms that we got, which were actually very, very quickly put down, was the first reaction is like, oh my God, Mako is buying an asset from Wexford. And I'm like, what are you talking about? We actually put out the press release. It was like it was not intentional, but the deal was supposed to close on December 30th. So we actually put out the wire on December 30th, and then I wanted that press release to go out in 2024. So we put out the press release at 7 a.m. on the 31st. But because the U.S. judge didn't actually give his final vesting order until 3:30 p.m. Arizona time, the receiving wire didn't get received until the morning. So Mako put out the press release before Wexford actually owned this. Wexford owned it at 11 a.m, so about 4 hours after the fact. So it's not like we bought this from Wexford didn't own it. Like when we did it, like Wexford just established this thing for the sole purpose of acquiring it. But you're right, it's like having somebody there in the background to help was like it was a godsend. Like this would have been a very, very different transaction otherwise. I will say that for those that aren't aware of our structure, our nerve center is in Arizona, right? So what I would consider to be like, I'm in New York, but I'm one of the least important members of our organization. The real nerve center of our operations are in Tucson, in the southeast part of the state. Moss is on the northwest side of the state, solid 5-hour drive away. But at the same time, we're there. We kind of like know the areas. We know the people who to hire, who are good, who are bad, who to supplement. And when you look at kind of like what Elevation left themselves in, and again, a lot of those decisions were coming from a rational place. This was not going to be an asset that was going to be attractive to like a mid-tier mining company, because what was left on the table relative to the amount of diligence that people needed to do was not that big, right? So we have this situation where just the visible mine life that we have right now is, without doing anything, is about 3.5 years. If you actually move that crushing plant, that can get extended to about 6. And then you can start taking a look at the broader property. I don't think anybody would have invested the amount of time and effort that you needed to do something for this small, unless they actually already had infrastructure in the state, which we do, or they were looking at this from an exploration play. it turns out that we knew enough about this asset to know that this was not just about the 6-year mine life that we're acquiring, but this is like 165 square kilometers of ground that we know that they made another discovery over here. And if you actually have like systematic exploration, especially with a new permitting regime over here, we now control, I think, 70% of the entire Oatman district. So our anticipation is that this is actually going to be not just this kind of like super cheap asset that we get, and we'll be able to get our acquisition price back within a quarter or two. So yes, that's good. Like, don't get me wrong, that's actually a good thing. But we're looking at this as that our entry price over here is not just about the mine that we see. It's really about our entry price into in the district, and that can be like a complete game changer in terms of what this is about. So I made this. I was hinting into the public markets in various speeches that I got. Is that I was telling people like what was coming across my desk in the context of a gold market that already went into the bull market mode. Like, we've been in bull market mode since October 23. So within it, like in a year into the bull market mode, I don't think in my entire career I've seen more accretive transactions come across our desk. And like, this is one of the things. It's not the only one. It's one of the things that I was referring to, is that if people kind of understand what Moss is about, again, what Moss is about in the context of all the liabilities going away and kind of like putting best practice from a mining perspective. And I've never seen an acquisition that could potentially be this accretive before.
Yeah. So we'll hit pause here. We'll let Frank outline the geology from his point of view, and then we're going to come back and speak about the sort of operational things we can work with. So, right. So we've discussed with Akiba now. Now Frank is going to tell us a bit more about, actually the geology here. And you haven't published that much information yet. I guess some people in the know have been able to get some information from the past company who owned this project, but let's just speak about it. If you give a high level view, what sort of geology are we dealing with here? Start there.
Okay. Yeah, actually, we're really excited to get started on the Moss Mine. The land package is actually similar to what we have in San Albino. We have a huge land package. It covers over 165 square kilometers in the Oatman district. Here, this is Oatman, which was a historic producer. They produced over 2 million ounces of gold out of Oatman. It's got excellent infrastructure. We're about 10 minutes by road from Bullhead City. And the other side of the Colorado River is Laughlin, Nevada, which is a number of casinos. We have a reliable electric grid that serves those casinos in Laughlin, Nevada. So the concessions measure about 30 kilometers by 2 to 10 kilometers wide. So looking at in the area, as I mentioned, we have the Oatman district, which produced over 2 million ounces of gold. Arizona Gold and Silver, just to the north here, which is contiguous, part of the same district, just announced 58 or 55.8 meters at 1.3 grams at their Philadelphia project here. And then we have Gold Road Mine here, which had approximately 500,000 ounces. So if we dig a little bit deeper into the land package, we have the hyperspectral satellite mapping that covers the entire concession. And this identifies alteration minerals. We say probable alteration minerals because it's actually looking at the different color spectra. Yeah, so one of the big differences between Moss Mine and San Albino is that at Moss Mine, there's a number of tools that we have that aid us in exploration. So there's very little vegetation cover, and we're able to use this hyperspectral alteration mapping that helps you zone into different areas that have different types of clays that can be formed at higher temperatures. And you're actually able to distinguish that. We also have the ability to look at the different textures of the vein and alteration minerals that help us to zero in onto areas that are prospective. whereas in San Albino, it's a little bit more blind. We rely a lot on the local miners to identify some of the areas. There's also a lot of extensive geochemistry that's been done. All of these dots that you see here are gold and silver showings or mines. And these colors here are these different alteration minerals. So if we take a look at kind of the central area with around the Moss mine, this is zooming in. This map's showing gold from rock chip samples at surface the previous owners have taken. So in purple here are ones over 3 grams per ton, and red is 2 to 3 grams. So anything over in yellow or orange, over half a gram. So you can see that that actually outlines the veins pretty well at surface. Excuse me. And there's also geophysics done on this area, which is another tool that that'll help us to delineate targets. So right now the plan is to do some mapping in the pit. When a mine is kind of starting to close down, the first thing that goes are the exploration geologists and then the mine geologists. So unfortunately, in the last year or so, there wasn't much geology done at the mine here. So we want to get in, do some mapping in the pit. That'll aid us in the grade control and also in the blasting. And then the next priority will be to look at expanding the resources. So stepping out to the east and to the west. And we'll probably do some infill drilling on some resources that were defined here, follow up on those, and do some confirmation drilling.
And Frank, just briefly there, when you look at the discrepancy between what was mined, because we saw that the grades have been falling here sequentially for a few years at this mine, at least reported grades. If you look at the discrepancy between that and the estimations in the resource model and so on and in the drilling data, can you see a clear case of there has to be tons of inefficiency in how this is mined, use mining dilution right away? Or what's your take on that personally?
Yeah, we definitely have seen a number of areas where we can improve on the technical side. And that's actually one of my primary objectives here, is to get a good handle on what's controlling the grade and whether or not we can implement that into our mining method. Their grade control was pretty rudimentary. There wasn't any mapping done, in the pit. We do see, looks like, stockwork veining. So the question is whether or not we're able to do a better job with the grade control. What I've seen so far is definitely just by mapping the pit and implementing a grade control program, I think it will improve things. It will also help us with our blasting, because there are a couple of different rock types in the pit, and that's going to change how your blasting patterns, because they've had a real issue with getting too much oversized material. And a lot of times you're able to control that with the blasting.
Okay.
So I just shown in the blue stars the areas that have been drilled. So you can see not too many areas have been drilled. Most of it concentrated here within the mine property. They did some drilling here on the east extension. We'll take a quick look at the results on that. And then there's a number of other targets. They were kind of considering these greenfield exploration. They did some drilling at West Oatman here, and we'll take a look at that with some pretty interesting results. And all of these are targets to essentially to follow up on. And then there's a number of other target types. So here we're looking for these epithermal, which are fairly shallow gold veins that often have a zonation. So often you can get into a sweet spot where you actually get pretty high grade. Traditionally, that's what was mined, like in the Oatman district, where they had high grade on the vein deposit and mined it underground. We're mining the upper part of this, which is the stockwork zone, in a lower grade, but bulk mineable. These other targets here, and you can see the difference in colors. These are extensive clay altered zones, which are more of a porphyry type deposit. So farther down the road, we'll look at advancing a lot of those targets. But in the near term, we're focused on adding additional resources to the mine. And then there's another of other targets. So just in this small area right around the mine, we have numerous targets to start chasing. Take a quick look. This is the Reynolds pit. So this is the mine. This is an older photo. So they've actually started mining in this area. Those weren't put into resources. It was based on their internal resources, or internal resource calculations. So they've defined an area here with drilling. You can see some of the grades here. This hole is actually drilled down dip. It was 225 meters at 0.56 grams. And then these other holes were drilled back across 92 meters at 0.4, 100 meters at 0.5, and 108 at 0.3. So similar grades to what they're mining historically here. So that's going to add. That actually, they left. There's a blast left here, and that's where we're looking to restart up the mine. And then they did drilling here at Mordor. You can see the grades here. And then this other area, which was they considered part of the expansion, they had similar kind of grades, 40 to 50 meters deep. So that's within the mine. This is a section.
Just briefly, were you planning on restarting the mine? Is that a reserve confidence level at this point in time in that location, or
They did a fair bit of RC drilling. In fact, we're just assessing that and see if we need to do some additional drilling for us to be confident in it. But they actually did quite a bit of drilling, and they were fairly consistent results.
Okay.
So this is a section actually through that Reynolds pit area. So this was the long hole that they drilled that had, this was the 225 meters at 0.56. But actually it's going down dip, and then they came back across and drilled these holes and got similar kind of grades that they're getting, that they were getting at the existing mine. Some of them a little bit higher. You can see here's 50, almost 60 meters at 0.6 on this hole. This hole had 51 meters at 0.55, so 0.6. So it looks like this holds up pretty well from the drone that we've seen, but we probably will do some additional drilling and see if we can characterize it better. Okay, this is actually stepping now out on the eastern side, about 100 meters east of the current pit. So they intersected gold and silver mineralization in the moss vein. This was down about 110 meters below surface. And it does appear to be getting better grade as you go down dip in this area. It was actually blind at surface. So a lot of times you'll just get some slight indications. You might get calcite veining without any with any quartz. And then as you go deeper, you're getting into the system. So this area was blind at surface. But this hole 22 intersected 32 meters at 0.8 grams. And there was a higher grade interval there of 12 meters at 1.6 grams. They have the two veins. There's the Moss vein and the Ruth vein, and we see that through the pit. Just showing this was the east pit, and this is where that line of drilling was. Okay, we'll look at a few other targets that they've identified. This rattan. This is actually on the property. Some interesting surface numbers. It's almost 3 grams over 5 feet in a stockwork at surface, up to 8 grams over 2.5 feet. You can see here the vein and the grades, a bit higher grades in this area. But it's partially covered by a leach pad in the western part of the mine site. So that's an area that we'll look at doing some drilling, see if it would make sense to move that leach pad. But this is open and it hasn't been drilled. Okay, going to the west here, this is called the western extension. At surface, it's a broad stockwork zone. There's high grade scattered around. There was 6 holes drilled historically, but they weren't able to get the data on that. And this was just a map that I found where they were outlining some drill holes, but you can see these triangles are 1.5 grams to 5 grams. So there's some higher grade here and a fairly broad area with other veins farther to the south. So that's actually stepping out to the west, just west of the current limits of the mine. And then I think the last area I'll talk about here is this West Oatman. It's a couple of kilometers to the south. They had it's kind of interesting because in 2021 they announced unreleased drilling results, which were pretty nice results, 53 meters at 0.81 grams per ton gold. It's exposed at surface. There's a breccia. And the location of the target. And this was the drilling that they did. So kind of 20 to 40 meters at, this was 0.7, 25 meters at 0.5, 42 meters at 0.8. So this actually looks in the size of it, almost a mirror image of the Moss vein. And just a few pictures showing the core. You can see this stockwork veining, quartz veining that's carrying the grade. This was, well, they have it in feet, 49 feet at 0.7 grams. And this is a higher grade zone within it, 14, is around 14 grams per ton here. Just to showing a few of the sections. I apologize, it's going back and forth with feet and meters. A lot of this data we've just gotten access to, and we're putting it all together. But here they're seeing that they had 60 feet at 0.4, and then a little bit deeper there was 70 feet at 0.5. So they were thinking that the mineralization or the grade may be increasing down dip. Another section with similar kind of grades. This was 90 feet at 0.8. And another section. Here on this section, you can see it is getting a bit wider and better grade as we went down dip. So those are kind of the main targets that we've developed right now, and we're just right in the middle of doing the work to prioritize the targets, get out and start exploring this year.
So Frank, I mean, essentially, you guys are prioritizing a mine restart here, and there's many ideas to pursue. You're just getting a hold of all of the data, getting familiar with things. How would you characterize the path to mine restart and the most priority targets? Where you're going to place the first couple of holes? Where do you see the most obvious ideas?
Yeah, so I've got actually a team of geologists coming out next week. They're going to help us out to complete the mapping in the pit. So the first priority is to uh, map the pit so that we can bring that into production as quickly as possible. We want to make sure we have that mapped and then use that as a guide to go out and visit some of these other areas on the ground. The first targets we'd like to step out to the east and to the west because we'd like to bring in resources as quickly as possible and then follow up with additional targets that, what we're looking at is on the permitting side too. We can expand our permit quite easily in a shorter time frame. So I'd like to step out, anything that's contiguous with the current mine permit are our highest priorities, and then look at these other areas that we can bring in down the road.
And in terms of sort of initial scope for doing some drilling and so on, um, how many meters do you think you would deploy? Say in the next pre-mine restart, realistically, or something like this. Budgets might not have been finalized, but if you just give a gut feel of what you think would be required, realistically.
Well, it would be probably similar here. Uh, we're we're kind of putting together our budgets, and obviously the budgets kind of depend on the mine, the mine production, getting that going. Um, so we're actually working on that now. The budgets to put together. I'm just, yeah, they drilled about 15,000 meters, about 83 holes. That was infill drilling to define additional resources. So it'd probably be along those lines. 10 to 20,000 meters.
I mean, and generally, it's oxide drilling, so generally it doesn't go beyond 200 meters depth for sure. So
Right.
swift drilling, you could potentially say with West Ottoman define a new higher grade pit, within honestly a quarter and start mining there, in my view.
Yeah, and that's actually one of the things that we like to do is uh, add resources quickly and do it as efficiently as possible. Yeah.
Yeah. Okay, but I think that gives a very good overview for now, and then we'll have to just wait and see where the apple falls, I guess, here as you guys do the initial mapping and get your hands on or your feet on the ground a bit more. You've already had it for some time now, but it's still fresh. It's still recent.
Right. Yeah. Yeah. It's fresh with huge potential. And
Yep.
first thing is to bring the mine back into production, which we're pretty confident that we can do pretty quickly.
Okay. Perfect, Frank. Thank you. Okay, so the operations, you alluded to there being serious sort of personnel problems, probably several mistakes in terms of bottleneck issues and so on. Can you speak to the existing operational issues, high level, and how you could resolve? I mean, well, let's Jesse go into detail on how they could be resolved. And how would you characterize more broadly how you get this asset into how you turn it into a good economic unit by the end of this year or something like this? What's the plan?
Right. So all of the issues all come from lack of controls. So is the financial aspect of it, but like from an operational perspective, well, I'll keep coming back to this lack of control and all the touch points that this actually means, because they're all somewhat connected. So let's start from the nerve center of any operation is the laboratory. That lab was a joke. Like I don't believe any number that that came out from that lab over at Elevation, and think of the implications. So think about what that actually means, right? So, well, how do you know what the grade is the positive if your lab doesn't work? Well, usually the way that most people calculate grades is that you try to have a handle on how much gold you sell, right, at the back end. You try to have a handle on how much inventory you have in the plant, and then how much goes out the back end in tailing. So even in Nicaragua, we do this. We actually have like a really well functioning lab. We sample all over the place. We have pretty decent estimates on our plant mass balance. We measure the tailings grade coming out. But at the end of the day, we do back calculate our head grades based on how much gold we sell. And this is in the context of a plant that processes gold within 36 hours. When you're dealing with a heap leach mine, where you don't actually get all of the gold out, and effectively no tailings. I mean, the heap leach is the tailings deposit as well as the primary production center. Your back calculation of gold coming out is based on how much you sell, and then based on your model of what your leach cycle is, your recovery factor. Based on how they're measuring it, I think their recoveries are just made up. Like you can't. They picked a number, and then that's why they think that they had a head grade of, let's say, 0.45, 0.46. I don't believe that number at all. Then that's one end. So your nerve center is not working. Now you go into the pit.
What do you believe then? What do you believe?
I believe how many ounces they sold. They got paid for it, right? So, and then
so you think they're losing a lot of gold?
It's possible that it's like the actual leach pad, when you look at it, and I think a lot has to do with the competency of the rock. I don't think they were leaching particularly efficiently. Actually, the leach pad's in pretty good shape, right? So I don't think they were actually like losing gold over there or condemning any part of the leach pad. You're going to have to like rework how some of the solution is applied in various parts of the facility. But I wouldn't be at all surprised that the actual recovery was lower than what they were reporting, and the actual head grades were higher. Net winds up being the same coming out the back end. But here's the other thing: to save money, they laid off most of their geologists, inclusive of geologists in the pit. So there's nobody other than doing some blast hole sampling that was coming in, but again with a laboratory that I don't think worked. There was no geologist in the pit looking at the contact of some of these rock types. Like obviously in Nicaragua, that's critical because we need to mine on these 1 meter wide veins. Here you have these 30 meter wide breccias that you're going to need to go and mine out. But, and here's the other thing that goes with this: when you don't have a geologist on site, you don't have like a pretty decent view of the contact points between the rock types. And this becomes important when you're establishing like blasting patterns over here. So the one unequivocal negative about moss, actually one of the reasons why the leach pad holds up so well, one of the reasons why you can get like steep pit wall angles, is that the rock is very hard. So you need to put in a lot of explosives to get it going. If you don't have preferential blasting patterns on your rock contacts, well, then two things are going to wind up happening. You're going to wind up having a lot of oversized rocks, and then two, you're going to wind up having a bunch of dilution going into your plant as well, which I think kind of like matches my theory that the actual head grades were higher. But going back to the oversized boulders here, is that there were some moments where these guys weren't breaking their rock down fine enough through blasting that they would have to rehandle in quadruplicate, right? So like 4 times over. And they had a mining contract that was different than their blasting contractor, right? So the blasting guy was doing their thing without geological control. Their mining contractor was doing their thing without any mine engineers controlling them from elevation, doing their own thing, having quadruple rehandling costs associated with it, and having a contract that was charging everything back to the company on a cost plus basis. So there were certain quarters that elevation was paying in excess of $11 a ton for overall all-in mining costs here, where we have like one of the more complicated open pit mines in Nicaragua. But even with that, we have our marginal cost of the mine is below $3. Like here, if we like this is it's a hard rock. It requires a lot of explosives. It requires a lot of like hand holding over here to engineer it correctly. But if we get this thing down from 11 to 3, kind of like what it should be, like on the high end of the spectrum for the industry, you're saving like $6-7 million a year just doing that. And then on top of that, so all that comes back with a lack of control over here. It wound up talking about like real material impacts from a pricing perspective and a cost perspective. And on top of that, because of all these oversized boulders, you had this undersized front end of the crushing unit, which was incapable of processing these oversized rocks. So you always have this like bottleneck over here. So the plant was in great shape. It happens to be placed on top of 120,000 ounces of gold, but the plant itself is in great shape. And it should be able to run pretty easily 11,000 short tons a day. It never really had a single quarter where it consistently was running more than 8,500 because of this like front end bottleneck. So the part of that is on the blasting size and the oversized rocks, and part of that is just like the jaw crusher is too small. To make that replacement of the jaw crusher, which we're doing right now, is like a $200,000 deal. It's going to take like 2.5 months to get the part delivered and reassembled. But think about the position that they were in. This was like an insolvent company, and you needed to talk to your lenders over here and saying, guys, it makes the most sense for us to shut down operations for 3 months. I'm going to need some money to do that, like a capital infusion. Like I said, we put in $1.7 million to this company on top of the acquisition price over here. So we need more money from you to do this, and then you're not going to have like any like real cash flow other than residual leach for a period of about 3 or 4 months. Do you want to do that? The lenders would say no. Like I had enough. So even that they were kind of like bound by some of these bad decisions because of their financial messes as well. So all of that now goes away. Is that we have the ability to use these couple quarters of not having mining operations, just sorting out all of these best practices issues. But it just goes back to get it back under control. It's like we're not talking about doing anything that's like genius level like operations. It's just every single decision that you do needs to be based on some sort of evidence. So I started this discussion about the lab not working, and none of that is like a large capex. It's like training and maybe a little bit of equipment that comes with it. But all of that is like you just need to make sure that you know what you're doing, and then just do it. And I don't think the guys ever previously really were operating on that simple basis. So like nothing that I'm saying over here should be like a surprise to anybody. But when people are in a financial bind like they are, they're bad decisions that get made.
We heard Frank outline the geology. We've also chatted with Akiba here. So now we're speaking with the master of building and operating projects, Mr. Jesse here. So I guess speak to, you've been on site. You've sort of seen the mistakes that one might laugh about. But again, this company was under financial pressure, and you were able to acquire this mine. Can you just speak to the key problems you saw there, how you would go about resolve them, how difficult you think it is with your experience, and then the impact it will have when you resolve them?
Okay, well, as a private company, the sort of mining group, we've been doing EPCMs, we've been building mines for 30 years. The group that's with us now, some of them been with me for over 30 years. We've actually built and designed processing facilities from Merrill-Cross to CIC circuits and all that stuff. So that helped the group identify the mechanics problems they would have on mines. This mine, we started coming down here looking at this mine, 2014, way back when. We know about Moss Mine quite a bit. Us being from Arizona, we pretty much know this area very well. Fast forward to now, I definitely did see when we got here, we did a real short and quick due diligence on this thing. Right away, it was very obvious to us that the management was a big part of the issue here, and obviously the economics. Um, there was a lot of work being done with outside sources instead of doing in-house operations, and cost was out of the world here. As far as the processing facilities, other than laboratories needed big improvements, the process plant is running really good as we speak. It is processing about 2,200 gallons per minute of solution, pregnant solution. So we're producing right now as we speak. We had our first shipment, I think, 7 days after we took this mine over. We took it over on the first of on the 31st of December. So my biggest challenge right now is we have a crushing system that is got its throughput of about 10,000 tons per day, and also about a minus 3/8. And obviously, I think Frank alluded a little bit to the oversized material that they have here, and had meetings with a contractor, general contractor here mining. There was a big discrepancy there on the blasting and the drilling, blasting, and hauling, and oversized material showing up to the crusher. At that point, they were spending a tremendous amount of money reducing the size of the rocks to be able to go through the primary crusher. That was really a big issue on this mine. One of the things stuck into geology is that from now on we're going to have control of the blasting, the drilling and blasting. We're going to be drilling and blasting according to geology. We're going to look at what we're drilling, what we're blasting, what type of rock it is, so that we can adjust our blast patterns, our powder factor, all that kind of stuff to try to reduce the rocks at that point. We're also going to be analyzing the fragmentation of the big rocks within the ore bodies, and if the big oversized rocks do not represent any value, why take them to the heap? Why put them up there? Sometimes it costs you more to reduce a rock size than the gold value on the rock itself. So we're going to be doing a lot of that work in the next month or so. We have in the Reynolds pit, where I think Frank mentioned a bit on that Reynolds pit, there's about 400 ounces left of a material that it's got to go to the heap as soon as possible. We intend to do that within a few weeks here, start running that over through the crusher. So there's a lot of activities going on here on the mechanics. We're trying to get the mechanical back where it needs to be. Most of the upkeep and maintenance on a crusher was being without using outside resources. That's got to be done in house. So we're getting ready to change that to be able to lower the cost on the upkeep of the equipment around here. So there's a lot of challenges, and the other thing is going to be restaffing this company. We cut them all the way down to about 32 people. So we're very running it with skeleton crews right now. But at the end of the day, I think we have a good plan here for this mine to go forward. Like I said, there'll be some money to be put into the laboratory. Even though they're producing good assays, the facility needs to be upgraded. Do some upgrades to the crusher. Other than that, I think it's just try to improve the practices on leaching the heaps, getting solution to the ore on the heaps. I think there for a while they went going after the not they were not waiting for the full 120-day cycle on the heap. They were trying to get ounces to make some payments, so they were advancing the leaching faster than needed to have the full recovery from the ore on the heap. They were just chasing ounces, and we're gonna go back to where you do a full leach cycle, get all the ounces that you can from the ore as you go through, instead of chasing ounces just because you got to make payments. That puts a bad cycle of leaching and recoveries on a heap. So a lot of little things happening, but they all amount to a big problem here.
Yeah, yeah, but it sounds like mostly. I mean, you have some capex. You need to fix the lab. You need to fix the crusher. Not we're not speaking. I mean, it's going to be a few $1 million to my ears, and then
Right.
it's mostly process rehiring. You're starting from scratch, redoing that. But so can you just characterize in your mind how long that will take? Just characterize activities again. Just approximate time in your mind to restart, and then from restart to fully ramped up. What do you think is achievable? What are you gunning for?
On the operations side, other than people staffing, and we have a full mine engineering team here from our company that's here and supplying all the technical work that we need to do. Restaffing is going to take some time, but at the end of the day, I think the previous senior mine engineer that was here, his name's Kyle. He did a really good job as far as keeping a good mine plan going forward, and we do give him a lot of credit because our senior mine engineers came in and just took over from them, so they're going to be pretty much picking up where they left off, and we have a little bit different mentality. That I think they were looking at an expansion plan here, and they needed to move some stationary equipment like the crusher and all that kind of stuff. But so I think we got about 3 years, maybe 3.5 years before we have to worry about that. I think Frank mentioned on the Reynolds pit, that if we go after that, we definitely don't need to do a layback on any of the pits yet. I think we need to get some ore that did not require a big capex coming in if we need to do a layback or if we will do a layback. But I think the time to do this, I definitely see ourselves within a couple of months. My mine engineer team's telling me that they got the scope of work pretty much done to go out for a bidding on for a mining contractor. So they will be going out for bid here within 2 weeks. So once we get a mining contractor on board, is just start drilling, blasting, and hauling to the pads. So I'd say within by May we should be uh, pretty much where we need to be to start supplying, tons to the heap of fresh ore.
And would you expect the mill to be running at full capacity into, say, early Q3, or what's your expectation in that regard to sort of be at the nameplate?
About early Q3 would be a good target there.
Yeah. And that would include implementing, these best practices that you guys have in your other operations to resolve some of these previous issues with, blasting, etc.
That's correct. That this mine will be at the beginning right now heavily supported with the external engineering from our group, and as we bring in people, we will be phasing out our people and heading to the next project, like we done with San Albino down in Central America. So that's the plan here. Like I said, we made a big deep cut on personnel. We needed to, especially we started from the top down, and so we are pretty full control of the mine right now, and we are right now in full effort right now to replace key personnel to this mine, and so we can start bringing in all the labor people, all the mechanics, and all the operators, and everything that needs to be done here right now. Like I said, right now they're running. It's kind of a skeleton crew right now, but it's keeping everything safe. So far, so good. What's going on here?
Yeah. So I mean, it's perfect. You guys will have this thing up and running well into Q3, and then it's getting really close to head over to Eagle Mountain and get that thing built as well. So you're staying busy.
Yeah. No, we're very proud of what we do here. We've done this quite a bit with the crew that we have, like that San Albino mine in Central America. We're very proud that mine is probably about the only one in Central America that's got dry tails stacking. So basically, you place the tails today, you're driving on them on a vehicle the same day, right? So, and I think we're the only ones in Central America doing that. So we do bring in very latest technology and safety and out to the operations everywhere we go.
Yeah, excellent. And it's working very well for Mako shareholders as well. So it's
Yeah.
perfect.
Well, that's something to be mine is running about over 1,500 days with no zero lost time accidents. That's something for all the crew to be proud of on a project like that in Central America.
Yeah, 100%. Okay, Jesse, thank you for your time.
Thank you very much.
So the things that are working, the leaching is working quite well. The heap, that's fine. The processing plant works fairly well. There's some items you need to address, but it's in the wrong location, right? So that's a sort of an issue. And is that something that you address before you start operations again, or do you defer it after potentially Trump changes the permitting stuff and you can move it to? I'm not sure. I mean, how do you think about moving the plant? That
I
item.
mean, it's a big deal to move a plant, right? So that's definitely one of those items where that's a kick the can down the road decision, and try to avoid making that decision for as long as possible. So we have 3.5 years of material available where we don't actually have to do anything. We don't have to change our permits. We don't have to do anything. No real capex that needs to come with it. Leach pad capacity is there. Don't need to move the plant. And then there's going to be, within that 3.5 years, a couple of decision points, right? So one of the new areas of mining is actually outside our current resource, which is the Reynolds pit. There's a very, very small amount of that in the 2021 resource and reserve report. But that's actually going to be one of the primary sources of ore. And I get to use the word ore because there actually are 2P reserves over here. Is that it appears, because it is a different rock type, it appears that the grades are getting somewhat better to the west-northwest and somewhat better down dip. So we're right now permitted through one of those crazy land swaps that they did with the Bureau of Land Management to do the Reynolds pit right now. We can always go through a similar thing where we can keep expanding to the west. And then likewise, more impactfully, I actually do think that they made a discovery 4 kilometers to the south in the West Oatman area. So we can incorporate all of that into the mine plan, and then use that in the current plant that exists. But in a worst case situation, let's say all of those, like the permitting regime is not as good as I expect, we can't bring another deposit into the fold. In a worst case situation, we'll have to spend what's likely going to be probably about $4 or $5 million to go and move that plant somewhere else to access that 120,000 ounces of gold. So it's a decision that we'd rather not make. It was kind of silly for them to do that. In fact, there's probably other areas of the deposit that weren't appropriately condemned as well. But that's, in our minds, a worst case situation. But ideally, we're going to be feeding that mill from other locations for a lot longer than the 3.5 years that we have in front of us right now.
Yeah, and probably within H1, if the executive order is actually carried out, which it should be, then it becomes easier. You don't have to do this plus minus rigmarole where you subtract here and add there to get exactly. This.
Yeah, like at the end of the day, like you can see why they made the decision, because they were running out of space, right? So it's like a lot of the decision was, well, how do we get this thing up and running really quick without doing all the necessary work? And I think if you actually, people that don't look at Mako really carefully, there's a lot of similarities to that. So we definitely have the same DNA, is like get this thing into cash flow really, really quick. So we're kind of in the same part of the Venn diagram, if you will, of the previous versions of operators. But we would never, ever make a decision which isn't based on data. Like, so we have the same motivation of doing this, getting things into cash flow quickly, but at the same time, we're going to need to have like evidence to make really, really big decisions. And if you think about this, so 120,000 ounces of gold, let's say at a 70% recovery over here, and in terms of the cost basis of what you're talking about, it's potentially something that's pushing close to $80 or $90 million of cash flow at these prices, somewhere in that kind of range, for a decision where all they needed to do was like poke in like 7 or 8 condemnation holes over here, and they didn't do it, right? So it's not a lost cause. It's not like that big of an engineering decision to make, but it is a substantial mistake that they made.
Yeah. Do you challenge any of the geological information you have, any of the resource modeling, or do you accept that as valid at this point with the information you have, or are you challenging anything in that respect?
Yeah, actually, so Elevation still has like a website. So they have like news releases going back all the way to 2011. They actually had an outside resource estimator that screwed up, like back in 2000. I think it was in 2013 or 2014. There was a material revision of their resource that was done by Scott Wilson. I think in doing that, so a couple of points on that front is that I think that was also indicative of people trying to do things too quickly, not actually understanding everything that goes into it. So, like, for instance, I'm not a geologist. I am like an engineer by training. But when we were doing that San Albino resource, there was not a single modeling decision that I wasn't involved with, right? So I was working. I spent at least 70 or 80 hours of my time, like hardcore hours of my time with Ristratelli on every single decision point on that model. And it's almost like you have certain mining executives that basically just outsource that stuff to other folks that become so impactful to your organization that I just don't understand how anybody can operate that way. So I think going through that exercise, though, and anytime that you actually have like a resource and reserve screw up, the scrutiny that goes in from even their professional licenses are such that when they do it again, it becomes more reasonable. That being said, like anybody, I've said this publicly before, like 85% of the data that's out there in this industry, I don't buy. I think they're like 43101 compliant in the most part. I've seen some pretty egregious examples where they're not, but I think for the most part, all of this comes into this whole ecosystem where you're like outsourcing decisions and stuff to other people. There's a lot of expertise out there that people can have, but it shouldn't be a substitute for internalizing every single decision point that you make within the organization. So it's a long-winded way of saying is that we had to redo our resource model in terms of what they've left. I think most of the stuff that they had in the broader scheme of things, I think, was reasonable. They weren't using their own internal lab to take those RC assays. So we have full confidence in the actual like assay data over here. And then from the modeling side, we'll always have like different approaches on how we're going to be developing the bones of the resource. But I think most people can view the 2021 report net of the depletion as like a good guide. But I've mentioned this before. Anybody in this industry that is making investment decisions on the back of a resource or a reserve statement is just it's a fool's errand, because unless you actually know what the tricks of the game are, I think most of this stuff is just unreliable, and it's just not a good way of underwriting an investment.
No, but and again, I mean that's why Mako is good, because you have the in-house competency to challenge and do first principles, all of these things, which is unique for your size of company. So okay, so the resource is acceptable. It's not something that's crazy or anything like this. So that's good. The plant, the heap leach is good. So let's talk about the mining. You said that you can essentially save $6-7 per ton. Is your expectation there to get back to the higher end of what you're seeing in the US, generally speaking here. So that's one big item. The second big item is obviously the royalties.
Yeah. That was just like the court. I mean, that's not like doing anything by us. But this is, from a financial perspective, this company is not the same thing at all as it was before. So at a minimum, those the stream and one other royalty are gone, and that was the bulk of the royalty. And then the 4%. We anticipate running this thing because of the debottlenecking and because of the grade control. We do expect this to be running at least from a gold ounce produced perspective, a lot higher than 32,000 ounces a year, the average that they had for the last 5 years. It's going to be pushing 40, if not higher than that, per year, when all is said and done, assuming those things of the debottlenecking and the grade control prove to be accurate.
And just briefly break down the translation from 32 to say 40, 45. What main items and the resolution goes into that taking place.
Yeah, so I mean, like debottleneck the plant, and you can easily add 25% to your production just on that basis. I don't think you're
Throughput.
actually particularly mine constrained. And then
Yeah.
there's stuff that we don't actually have, like true hardcore evidence that they were experiencing more dilution than they should have been.
But you think so?
I can't imagine that
You see a lot of evidence for it. Okay, so when you're saying getting from 32 to 40, that's just debottlenecking, and then you'll see if the average grades also come up when you structure the mining side of things there mainly,
Yep.
and get that straightened out. And in terms of our cost savings, you expect the processing costs and these things to per ton to come down to be fairly reasonable or similar to what you have currently. Is that and what's that sitting at currently? If you just give the unit inputs on the operating costs.
Yeah. So when in the last few months of their processing, or like new material processing, going through the plant, they were getting, and again, this is like a 3-stage crush heap leach mine, albeit with hard rock. They were getting about $12.50 a ton in operating costs, which is really, really high relative to where they should be. So unlike the mining side, where there was clear obvious things that were going wrong, processing side is maybe a little bit more subtle. You have like a few things where, like, obviously running this thing without bottlenecks is going to be helpful, in general. You'll get the costs down in that regard. And here's like an interesting thing about them. And again, I encourage people to go to the Elevation website and look at all the news releases since 2013, is that when they were going into the commercial production, so going through this EA from that pilot plant in the context of 2017, they were looking at all forms of debt and stream finance on this, right? So initially they hired Macquarie Bank to take a look for debt finance, and they actually got a loan from Sprott Lending to go and do this. Sprott likes silver. I don't think that should be a surprise to anybody. And then likewise, they got a silver stream from Mavericks, that 120% of production, the way that it's structured right now. So then it questions, like, why exactly was this a silver stream? And because it's not really a silver mine, it produces maybe 6 to 7x on a volume perspective, silver ounces to gold. Ounces. So on a revenue perspective, you're probably like pushing in the mid to high single digits percentage from a revenue perspective. Well, the reason why they got this, why they got that kind of capital to go the Mavericks loan, the $20 million Mavericks loan, was principally done to refinance the Sprott loan, was that they were trying to optimize the plant to recover silver just to access capital. So they installed this like Merrill Crowe at the back end, where we're looking at this. It's like, why do you have that? Like, there's no reason. This is not like a 100-to-1 silver gold ratio over here. And like Merrill Crowe's are kind of like these kludgy things where you like blow some air and sprinkle some zinc and do whatever you do over there to get your silver out of there. But it really is there to enhance silver recoveries, but it winds up adding like $2 or $3 a ton of processing cost to this. The only reason why they built that was to access that kind of capital. So it was the cart before the horse type scenario. That being said, this was like a small cap mining company. They didn't really have access to a lot of capital. So they saw, well, this type of capital was available to me. How do I get my plant to be functional in a way so I can tap that type of money? So like even just stuff like remove the Merrill Crowe, and all you have to do is like turn like a valve and then run a like, I'm oversimplifying this, and then just have like an actual carbon column over here to recover the gold. You save like a $2 a ton, like just doing it that way. So there's stuff that we can now redesign, because we're not going to be beholden to other stakeholders that have like certain arrangements with this that really weren't related to the actual business objectives over here.
Yeah. So I mean, basically, you expect to process, say, would it be 4 million tons per annum or something like this?
Yeah, that sounds right.
once you get back up.
Yeah,
And you expect to.
That sounds right. Yeah.
And then the total mining plus processing costs saving, how many dollars would you say? I mean, if you're sort of playing it safe a bit, then.
Yeah, I think our thumb in the air is like this should be about a 750 instead of a 1250 type operation.
So you're slashing $20 million basically straight off the bat there, and you feel like, is this something you can execute within 6 months? So say by early H2 that you've carried through many of these changes.
Some of it. I think some of it will happen over time. Like the frankly easy stuff is the debottlenecking, which is on two fronts. One, just have like the right kind of blasting patterns over here to make sure there aren't oversized rocks, or at least have like an in-pit, like if not crusher, at least like some sort of like an in-pit mechanism in place where you deal with the oversized rocks before they go to the stockpile. So that's number one, where you can actually run things more efficiently that way. And then secondarily, it's eventually making improvements to the plant, which is going to, some of the things that we can do will happen now. So like the size of the initial draw, and then some of that is improvements that we'll make over quite a few quarters to come. So like it's not going to be like on day one we're going to be removing this $5 a ton of processing costs, but I do think like over time you can probably get down to something I love, because at the end of the day, a heap leach mine shouldn't be really shouldn't be like more than like obviously this is a 3-stage crush with hard rock. I mean, this shouldn't be like a $4 or $5 a ton like run of mine type leach. But yeah, no, it should be 758. That's more reasonable. But that was not what Elevation was doing.
And sort of input at the, let's say 2,500 gold, you're expected to recover, say, what is it, like $40 US per ton process or something like this on average, somewhere around there, 30 to 45, or that's the range of. If you say it's half a gram to 0.4 grams or something like this.
Yeah, so you'll need on a net recovered ounce basis, you'll probably need like around 80 tons of material to get an ounce of gold, something like that.
Yeah.
Because you have to factor into the recovery factor, which I mean they were saying 77. Okay.
And you're stashing a lot of royalties, which would be, I guess, initially, like how much would the initial those that are already gone in terms of annual burden on the cash flow?
Yeah, well, I mean, the small royalty that was paid out for a small amount of cash was nothing. It was maybe tens of thousands of dollars a year, maybe $50,000-$75,000 a year. The big one was the stream that got eliminated. So that if you actually ramp this up, right? So when I say $9.5 million, it was not what they were spending. They were spending it at a lower throughput, at lower silver prices. So if anybody wants to check what they were actually paying, it was a smaller number than that. But once this is actually ramped up to what the levels that we think it's going to be ramped up to, if you factor in 20% of the market price of silver at today's spot price for 120% of the silver ounce production, which we anticipate being over 300,000 ounces a year, you can wind up the spending like these silver prices, and potentially silver prices going higher, over $9.5 million a year. Just that.
Yeah, it's a lot of money. And then the net smelter returns. I mean, so 4% NSR on a not first quartile margin operation is a lot. I mean, it does eat into profits significantly, specifically when it's sort of high operating leverage. You'll bring that down, but nevertheless,
right. So that's the courts are going to decide that. The Judge Ballinger has agreed to look at it on an expedited fashion. I think I got
per percent NSR. What do you think the impact is? And then you just outline what you think the likelihood is from your point of view. Well,
1% NSR on 40,000 ounces a year is, what is that? It's $100 million a year revenue. It's $1 million a year, and then 3% would be 3. So between both of them, it's 4. It's $4 million a year, and then we would have to pay $1.5 million to get rid of them.
Exactly. So this and you guided in within H1 to get resolution on this.
Yeah, that's actually so Elevation is still in bankruptcy because this is like the last thing because there's nothing left of Elevation other than this royalty dispute. So they gave the outside date to the end of June. It could happen. Like I think the judge is a no nonsense judge, so I don't expect to be any delays on that front. And then likewise, just because this is so, I think, but I tried to avoid speaking for other people, but I think Patriot and Sandstorm are in a little bit of a different situation. From Patriot's perspective, it's existential. This is like essentially their only asset. And then from Sandstorm's perspective, I think they would rather not be forced to tell the market that royalties can go away in a bankruptcy, because I think part of the royalty magic is like, oh, royalties survive bankruptcy. I'm like, well, why? Well, just because you say something in a contract doesn't make it true. You either own the mineral or you don't. So that's what this hearing is about.
Okay, so I mean, essentially, we're expecting 40,000 ounces run rate, at least conservatively by H2 next year, or like getting into H2. You'll be
but that's for people shouldn't. This is a heap leach mine, so this does have I would say a mid-level type leach curve, so not super quick, not super long. So it will take time to ramp up. So usually leach for this type of leach kinetics, it probably takes like about 6 or 7 months to like fully ramp up. That being said, we're going to be in most of the gold will come out in pretty short order, so we'll be cash flow positive pretty quickly. But I wouldn't expect to be at like the finalized run rate for at least a couple quarters after the mining turns on.
Yeah, but I mean, you'll be there by sort of end of Q1 next year, or H2, getting into H2 next year at least. So at that point in time, you expect to say at this gold price, you'll be at 100 million.
Mm-hmm.
You'll probably at least make, you're already talking about slashing $20 million in just operating costs or something like this at the 4 million ton throughput processing level. So this mine will start making quite a lot of money.
I mean, you can see how this plays with people's heads, right? It's like, oh, Elevation sucked. They weren't making money. They were losing money. They went into bankruptcy. And then you start peeling out, well, why did they go into bankruptcy? They start peeling off the layers over here. It's like, well, why'd you buy this so cheap? Well, we bought this so cheap because it was in bankruptcy and no other like mid-tier like showed up. We were the only guys with but like this doesn't make sense. Like you're buying this for 5.1 million all in, and then you're saying you're making that. It's like, all right, tell obviously mining is tough. There's a lot of operational risks. We haven't even signed the new mining contract yet, so there's a lot of forward-looking statements that I'm making over here that may or may not pan out. But if you start peeling off the layers over this, people I think very quickly start to see is like holy crap, this is actually one of the most accretive transactions that I've seen for any like capital intensive industry, let alone gold mining.
Yeah. So I guess in terms of high level thinking on capital spend this year towards Moss, could you give a ballpark what you expect? And then people can think about how that will slot in with San Albino and with Eagle and so on.
Yeah, I mean, like it's a heap leach mine, so like you always have to like budget for leach pad expansions. Honestly, we don't even have space from a permitted perspective to do anything like immediately. But we do have space for about 3.5 years. So I think like once we actually get permits to do that, we're going to have to invest in some more pad space. But that's not like something. It's not something that, from a cash perspective, that we're paying in the context of the next 12 months. So most of the debottlenecking stuff is going to get done before we turn things on. Most of I think the overall capex that we have budgeted, leaving aside any potential like startup costs for the mining contractor, we'll see what that might be. So outside of that, just from December 31st to when we are going to make the decision to turn the mine back on, you're probably looking at something that will be about $4.5 million in total. But guess what? It's still producing gold. Like, right? I think we're gonna we're going to
Yeah.
wind up selling at least $3 million until that decision, maybe even more. So the actual net dollar number to get to the point where we turn the operations on, I don't actually think is going to be higher than the $1.7 million, let's call it emergency infusion that went in, just because. I mean, that's the other thing. This is not a fault of Elevation by any stretch of the imagination. I would do the same thing, but when you're selling your asset in bankruptcy and your creditors are expecting to get paid at the top end, what do? You basically you drain all your inventories down to the bone, and they did that, right? So we did have to make an emergency cash fusion just to get like a more safe level of inventories on site. But beyond that 1.7 million infusion, it's kind of hard for me to see actually what exactly we need beyond that, other than when we actually turn on the mining operations, which may require a mobilization cost.
So second to last sort of question or series of questions will be the if you just tell the story. I mean, so where do you see Moss at the end of this year, and then just put Moss into context with San Albino and Eagle in your sort of in your arc of storytelling here.
Yeah, so I think like by the very end of the year, it should be stabilized at its run rate. Like our mine plan, even beyond our optimization work, our mine plan actually is targeting a relatively higher grade part of the ore body first. So those grades should be higher than what was experienced the last couple of years. So we do think we're actually going to get to a level like 40,000 ounce run rate by Q4 this year. So number one. And then in terms of that, it basically from a production standpoint, it's very similar to San Albino. We don't know exactly what the new permitting regime is going to be in the U.S. now. They still got 22 days to issue the new guidance on NEPA here. So hopefully we'll be able to expedite some permitting, not on the broader EIS, which I think is still going to take some time, even in this new administration, but even stuff as small as exploration, we want to get around to really doing some regional work here as well. So there'll be some capital associated with that. And then as it fits into everything else from a schedule perspective, I got this question the day the acquisition was announced about whether this was going to impact timing on Eagle Mountain. And I told them, is like, look, the end of the day, having this asset gives us a lot more flexibility on how to finance Eagle Mountain. I think what people like to see, whether it's on the equity or debt side, is that they want to see cash flow that buttresses their investment, and they want to see a specific use of proceeds for a new infusion of capital, and this helps, right? So you now have cash flow coming from two locations, depending on I think now unequivocally it's going in a better jurisdiction. I think there was a lot of equivocation before Trump came in about whether the United States was a better jurisdiction than Nicaragua last year. And then using that cash flow from a lower risk weighting to be kind of like the carrot, if you will, to raise capital, knowing that the use of proceeds is going to go to Guyana, it actually helps. So I think if anything, the risks to our timeline for Guyana and Eagle Mountain getting developed have been reduced because of this transaction.
Yeah, very good summary. So I guess finally then is you do mention. I mean, you made this tuck in. It's not very capital. It's not like you're spending $30 million up front to acquire something, issuing equity. It's a small upfront consideration, very neatly done. Sounds like you're fairly quickly it's gonna become a cash machine that's paying itself back very, very swiftly. Then you're gonna have this thing up and running. So you still could enjoy taking a look at more opportunities, I presume. But it's a bandwidth issue because yes, he needs to and his team needs to go and actually fix this bloody thing. So it should become more difficult to find something logical to put into the pipeline.
So a couple of things to that. We were very fortunate and lucky. This was not by design. So in 2022, if we had some of our expats go on leave and like go on vacation, and then we had our San Albino plant, within 48 hours, you could tell. Like without even knowing people's vacation schedules, I said, all right, I know for a fact that Arnold's not over at site right now with the data coming out, because it was not running like perfectly smooth with 100% Nicaraguense personnel. Now that's the case. So we're actually able to move people from Nicaragua to Moss for our expats pretty easily, where that wouldn't have been the case 2 years ago. Likewise, Eagle Mountain right now happens to be, again, this was not planned, happens to be at the part of its development cycle where it's more consultant heavy. We're not hydro guys, we're not geotech guys, although we do have a geotechnician on site on staff. So we do need to have like outside support for that. So we actually don't need many of our expats in Guyana. That will change in the next 6 to 9 months. But it's clear that our team was somewhat stressed. So we're looking at this opportunity in a different jurisdiction that I had to cancel that I actually really liked. That it was like an interesting deal, but it was just like not suitable for our current team. That being said, I'm looking at assets in these particular jurisdictions that I actually really want. I'll give you like another risk about I had a conversation with Wexford about this yesterday, and I told Chuck, I was like, I'm looking at this one thing that I actually really like, and I told him kind of like what the likely terms on it would be. He said, wait a second, this isn't as good as what you did in Arizona. And I'm like, it's like now I know I really screwed myself because I did such a good deal in Arizona that everything is going to be compared to it. This should not be looked at as something that you can actually have repeat. First of all, there aren't that many bankruptcies in gold, and then likewise, the bankruptcies that you do see in gold, often you don't want the asset at the end of the spectrum. That being said, I don't think you're going to be able to find too many of these opportunities to plug in. That being said, I do want to have Mako to have a bigger production profile, more relevance, and being able to utilize our team in a more effective way. So we are looking at other opportunities as well.
But they would be, if they were bills, they would certainly be after Eagle Mountain because I mean, trying to fit that in before becomes. I mean, you're like 15 months out from construction decision, potentially.
Yeah, you look at investments that make sense. There's some things like this other one in another jurisdiction that I alluded to that I thought made financial sense, but we could not do because of how that would impact the rest of the organization. To the extent that something makes financial sense that we can fit in, we'll do it. I don't think we're particularly restricted about it's part of the decision process about how quickly you can get something up and running. But that's not the it's really those two things. Does it make financial sense, and can our team capable of handling it? And if those two things are good, great. We can always do more.
Yeah. That's a good place to wrap, Akiba. Long update. It was well deserved. I think this is amazing. So I mean, now it's just let's see the numbers Q3, Q4, and I think the stock will go a lot higher realistically. So it's very good.
All right, great. Appreciate it, Gordon.